You already know you need to invest your money to make it grow. And maybe your employer offers a 401k and you've been diligently putting money into it each week, month, or year. But do you actually know what a 401k is? And how is it different than a Roth IRA or even a traditional IRA? In this video, we're going to compare and contrast these three types of retirement accounts. They each have pros and cons. Each one is going to be good to use in different situations. So, let's dust away the confusion and get into the nitty-gritty. Are you ready? Let's go! Traditional IRA, Roth IRA, and 401k. All of these accounts are designed to help you save for retirement. It is definitely worth it to take advantage of the massive tax breaks each one provides. If not, you might be throwing away tens of thousands of dollars. Let's begin with the most accessible IRA on the market. IRA stands for Individual Retirement Account, and a traditional IRA gives investors pre-tax earnings and tax-deferred assets. That means when you file your taxes, you don't have to include your income if it went towards an IRA account. Until you make a withdrawal, the IRS assesses no capital gains, which is profit from sale of property or an investment. If you contribute $6,000 to your traditional IRA, your after-tax income is reduced by that amount. That is huge! That means if you put $6,000 into a traditional IRA each year, the tax savings will really pile up. Also, your traditional IRA assets will grow tax-free. When your stock assets rise in value outside of a retirement account, you have to pay capital gains taxes. You do not have to pay capital gains taxes as the money rises. Traditional IRAs offer a tax-free contribution, but when it's time to withdraw, it is taxed. That's one of the limitations of traditional IRA, and because of it, some people prefer the Roth IRA. But what's the difference? The sole distinction between a Roth IRA and a traditional IRA is the timing and the tax benefits. If a traditional IRA is taxed during withdrawal, a Roth IRA isn't. This is because Roth contributions are made after tax. Here is the best part. When you reach the age of 59 and a half, you can begin to take out the money tax-free. You heard it right. You will get tax-free retirement income. A Roth IRA does not involve your employer. Your investing options aren't restricted to what the plan provider offers because you set up the account. This affords IRA members more financial discretion, even though the fees charged by such providers are often higher. At first glance, traditional IRAs look good since they provide a tax-free contribution. But when it is time to withdraw retirement money, all of it will be taxed. Meanwhile, Roth IRAs provide you with a permanent tax advantage in retirement. If traditional IRA contributions provide instant satisfaction, Roth contributions practice delayed gratification. It is where you wait until retirement to reap the tax benefits. So, now that you know the contrast between traditional and Roth IRAs, which one would you pick? But before you decide, let's talk about their limitations. If you are single and earn more than $122,000, Roth IRAs are not an option for you. Roth IRAs, unlike traditional IRAs, have income limit requirements. Clearly, if your income exceeds the income cap, you'll have to go with a traditional IRA. You can even have both as long as your total contributions do not exceed $6,000 or $7,000 if you're over 50 years old. By far, the Roth IRA is leading the race. For millennials, it is better to prioritize Roth IRAs over traditional IRAs. With Roth IRAs, you can pay taxes once and never have to pay taxes again. The decision you must make is whether you believe your tax rate will be lower or higher in the future. If it's going to be higher, it's preferable to pay taxes now with a Roth. If you want to hear more about IRAs, be sure to subscribe to Finance Spark, where we post videos every week to spark your financial mindset. Oh, and hit the like button and then click the bell icon to be alerted when we release a new video. Okay, let's now talk about 401ks. A 401k retirement plan functions similarly to a traditional IRA. The real kicker is that it is company-sponsored. Most employers will match your 401k contributions dollar for dollar. It might potentially be as little as 50 cents for every dollar you put in, or even less. If your company offers a 401k with a corporate match, consider contributing enough to receive the full match. Depending on the 401k, That match could provide a 100% return on your investment. Some companies offer a 100% match up to 3% of the salary. So, if your annual income is $50,000, your employer will pay $1,500. You should also contribute at least the same amount. If your employer offers a 401k, you should always take advantage of it. Never refuse free money. So, you might be wondering, what is the difference between 401ks and traditional IRAs? Apart from the fact that 401ks are sponsored by your employer, the contribution limits are also much higher. As of 2022, you can contribute up to $20,500 annually, and when combined with the employer match, it amounts to a total of $61,000 a year. It means you can save a lot more money for retirement before taxes. Pre-tax contributions to a 401k are made before your income taxes are taken from your paycheck. So, when you withdraw your 401k, it will be taxed at your current income tax rate at the time of withdrawal. Among the three IRAs, a Roth IRA is probably the best choice. It gives a more flexible investment vehicle and more tax benefits. But if your salary is too high for a Roth, a 401k is hard to beat. Your company matches your contributions, and you can save more money each year. In a 401k, you can't actually choose your own stocks. You will just have a few index funds to choose from. An IRA, on the other hand, allows you to invest in any stocks and bonds you like. You may purchase and sell options as well as invest in real estate. So, with an IRA, anything is possible. Having a 401k and a Roth IRA is the optimum mix. You may and should have both. By the way, if you would like to know more about index funds, then be sure to check out our Index Funds 101 video. The link is in the description below, or just click on the card in the corner. If you want to improve your retirement plan portfolio, having both a 401k and a Roth IRA is a solid approach. Invest in your 401k up to the matching maximum, then fund a Roth up to the contribution limit. Then, you can use the remaining money for your 401k. In an ideal world, you would have both to put money down for retirement. But before making a decision, investors, and yes, I mean you, should study numerous regulations, income constraints, and contribution limits. Always do your due diligence before determining which retirement account is best for you. You can also have both a traditional and a Roth account. When it is time, you can choose between taxable and tax-free withdrawals. It also allows you to control your tax rates in retirement, which can be highly beneficial. In a nutshell, the source of your withdrawals and the way you spend them are significant for tax planning in retirement. You can have a 401k and a traditional IRA, a 401k and a Roth IRA, or all three. Financial professionals call this tax diversification. Just make sure you stay within the contribution limits. So, while planning for retirement, it's essential to understand your options and recognize your financial preferences. Your retirement account is your cushion to land on when you finally retire many years down the line. Knowing the best way to protect your money for the future is super important, and hopefully, this video helped shed a bit more light on how you can make sure you retire with a nice nest egg. If you liked this video, be sure to give it a thumbs up and hit that bell icon for notifications whenever I post up a new video. Of course, subscribing to the Finance Spark channel would be appreciated too. Thanks for watching, and until next time, keep sparking your financial mindset.